Welcome back to the deep dive. Today we're really digging into Celsius Holdings Q3 2025 results. And, if you just glance at the headline revenue growth, it looks like, wow, pure success. But our mission today is to look a bit deeper, right, into the strategy. Because the sources, they reveal a company that's sort of intentionally engineered. Well, we're calling it strategic chaos.
That's a great term for it, strategic chaos.
Ah,
Because this quarter wasn't just about growth. It was about radical transformation, massive acquisitions, a total shakeup of their biggest distribution partnership. It's huge.
absolutely. So the goal here is pretty straightforward. Understand how Celsius basically morphed into this total energy portfolio almost overnight. And, what does it really take to be ready for that kind of extreme scale?
Scale is definitely the word. Consolidated revenue, it hit about $725.1 million, which is just a staggering 173% jump year over year. But for you listening, here's maybe the most important number for the U.S. market picture. The whole Celsius Holdings portfolio. It now controls a 20.8% dollar share of U.S. energy drinks in tracked channels.
20.8%.
That's like incredible.
It's an enormous leap. I mean, think back just 2 years ago, they're, thrilled to be hitting maybe 10% with just the main Celsius brand.
Yeah, that kind of doubling of market share, that's what happens when you decide, okay, let's just buy the competition.
Yeah.
Celsius has now officially pulled together three really big players under one umbrella. You've got the core Celsius brand, obviously. Then Alani Nu, which they picked up back in April 2025. And then the really big one, Rockstar Energy. They got the U.S. and Canada rights for that just this past August.
Yeah, it's a complete identity overhaul. They're not just that fitness drink company anymore. They're basically saying, we are the modern energy company. Functional, inclusive, hitting all the right cultural notes, appealing to pretty much everyone. Okay, that sounds fantastic on a PowerPoint slide. But integrating three major brands, and remember, one of them, Rockstar, it's actually been declining. And Alani Nu, while huge, was built on a totally different distribution system. That seems like a massive execution risk. What's the key thing, the lever maybe, that makes this whole integration even manageable?
That lever is PepsiCo. Definitely PepsiCo.
Sure.
And the depth of that partnership is really what's fascinating here. Celsius Holdings got named PepsiCo's U.S. strategic energy drink captain.
Strategic captain. Okay, what does that actually mean? Like taking over the control tower?
That's a perfect analogy. Think of it like Celsius is now running the air traffic control for the entire energy drink aisle within PepsiCo's huge system.
Wow. So what can they actually do now with that captaincy that they couldn't before?
Well, it gives them immense operational control, real control. They now have the authority to actually shape the planograms. How stuff looks on the shelf. They can prioritize which specific products, which SKUs get pushed. They align all the promotions across different stores and channels. And crucially, they get much more say in grabbing those high traffic spots like the cold coolers near the checkout for all their brands.
Yeah.
Using PepsiCo's muscle to do it.
Right. That kind of shelf space power, that's like the holy grail in consumer packaged goods, isn't it?
Exactly. It's everything.
And PepsiCo, they didn't just hand this over lightly, I assume. They also significantly upped their ownership stake in Celsius Holdings. That feels like a big vote of confidence, financially speaking.
Oh, absolutely. It's a huge signal. It basically underwrites the entire strategy.
Yeah.
And, to make sure that massive portfolio actually works with their more people strategy, hitting every consumer segment. Each brand now has a very specific job.
Yeah, we see that in the marketing focus. It's really clear, almost surgical.
Precisely. Celsius, the original, stays focused on fitness and lifestyle performance, pretty much its core. Then there's Celsius Essentials. That's the newer premium line going after high-performance energy. Alani Nu, obviously, that's the powerhouse for female-focused lifestyle energy. And Rockstar, well, that's where the real work is needed. They're positioning it for culture, music, next-gen energy drinkers. They literally have a brand for every type of energy consumer now.
Okay, let's shift gears to the engine room. How did this combined portfolio actually perform at the checkout? Let's ignore the accounting stuff for a second. What did the actual retail sales look like?
Well, the momentum is just undeniable. Combined portfolio retail sales jumped 31% year over year. That's almost twice as fast as the overall energy category itself is growing.
31% growth on a portfolio that's already doing over $5 billion in annual U.S. retail sales.
Exactly. It's like running a marathon at a sprinter's pace. It's pretty incredible.
And the data really points to Celsius Holdings being the main growth engine for the whole category, doesn't it? Contributing something like 27% of all energy drink growth this year.
Yeah, that's an astonishing level of market influence. But like you touched on, the performance within the portfolio was, well, very uneven in Q3. Alani Nu was just the absolute star, no question. It was a main growth driver, delivering a triple-digit retail sales jump of 114% year over year.
114%. That's wild. The Q3 revenue just for Alani Nu is $332 million. This really highlights the power of flavor innovation, right?
Oh, completely. It hammers home that central truth about the modern energy market.
Hmm.
People crave new flavors. They want novelty. Alani Nu's seasonal limited time offer, that Witch's Brew, it drove record sales back in August. It tells you that functional drinks aren't just about the caffeine or the better-for-you ingredients anymore. The buzz, the excitement around these LTOs, it's a huge recurring driver for growth. It lifts the whole segment.
Okay, now let's tackle something that might confuse people looking at the core Celsius brand data. We see reported revenue growth of 44%, which sounds amazing. But then scanner data, which is usually a better reflection of what consumers are actually buying, showed retail sales growth of only 13%. That's a big gap. Why?
Yeah, that's a classic case of, let's say, financial accounting noise kind of obscuring the underlying health. That 44% revenue jump, it was mostly statistical noise. It's because they were comparing against a period in Q3 2024 where they had a big inventory optimization program.
Can you break down lapping a bit more simply for us?
Sure, it just means that in Q3 of the previous year, 2024, their reporting sales numbers were artificially low. They were maybe clearing out old stock or adjusting inventory levels with a big distributor partner. So because that prior year base number was unusually low, the Q3 2025 number looks comparatively massive. It's a bit of a statistical fluke. The 13% increase from scanner data, that's the truer, organic measure of how the core brand is actually doing at the shelf, which is still solid growth, by the way, helped a bit by some early international expansion, too.
Got it. And then the third piece of this puzzle, Rockstar Energy. What did we see in its first month under the Celsius umbrella?
So Rockstar brought in about $18 million in revenue in that first month. However, the existing retail sales data for that period showed it was still declining, down 9% year over year. It's pretty clear from management's comments that this acquisition isn't about getting an immediate growth boost. Not at all. It's a strategic play. They're taking on a turnaround project. The goal is to stabilize it, optimize it, and then use it to capture that next generation of energy drinkers. The ones who maybe aren't drawn to the old school high sugar brands.
Right, which brings us perfectly to the Q4 turbulence. You use that phrase strategic chaos at the start, and Q4 sounds like it might be peak chaos. What's the biggest single operational headache they're dealing with because of all these changes happening at once?
It's definitely the huge distribution overhaul for Alani Nu. That's the main driver. Starting December 1st, Alani Nu is moving a massive chunk of its current U.S. direct store delivery, its DSD network, over to the giant PepsiCo system. Just imagine moving product, paperwork, logistics, everything between roughly 250 different third-party distributors and plugging it all into PepsiCo's integrated network. It's an epic undertaking.
And this shift led to that massive charge on the Q3 income statement, right? That $250 million number. We should probably unpack that $247 million distributor termination expense.
Yeah, that expense number is really crucial to understand properly. Yes, Celsius recorded about $247 million in these termination costs in Q3. And yes, that creates significant noise on the official GAAP accounting statements. It makes the P&L look, frankly, extremely costly for the quarter. But, and this is the key financial nugget, PepsiCo fully funded those costs. It was part of their long-term agreement.
So it shows up on the books as an expense for Celsius, but it doesn't actually cost them any cash.
It's a net cash neutral deal for Celsius Holdings, which, if you think about it, shows just how incredibly committed PepsiCo is to getting this whole energy portfolio running exclusively on their trucks. They basically ate a $250 million termination bill just to get Alani Nu as smoothly integrated. That says a lot about the power dynamic in this partnership.
Okay, so if the $247 million is mostly just accounting noise, what kind of real disruption, real operational noise should we be watching for in Q4?
Well, management was very direct, calling Q4 a noisy quarter, specifically because of all the integration work. The pressures are going to be operational, things like higher scrap costs as inventory gets moved around or potentially damaged, increased freight costs, definitely. Because you've got this complex dance of inventory movement returns coming in from the old Alani distributors while simultaneously building up new inventory in the Pepsi network. Plus, you've still got ongoing global tariff pressures and just the usual year-end promotional activity and cash management stuff. It's a lot happening at once.
And the payoff for managing all this integration headache, it isn't immediate, is it?
No, that's right. The big financial win, the synergies you get from combining logistics, maybe using the same co-packers, optimizing freight routes that's expected to be phased in, It'll ramp up through Q4, but the real full margin benefit from getting Alani Nu into the PepsiCo system, that's really expected to kick in starting Q1 2026. This Q4 is all about building the foundation, not hitting peak optimization just yet.
And speaking of costs and margins, are we seeing any hints about raising prices for consumers to help offset some of those headwinds like tariffs or commodity costs?
Management is definitely thinking about it. They talked about contemplating price point adjustments across the whole portfolio. They're actually building out a dedicated revenue management team, which tells you they want to be really smart and precise about how they handle promotions or maybe take some frontline price increases. Nothing's been announced formally, but you can see the pressure points are there and they're looking at it.
Okay, let's zoom out to the bottom line for Q3, beyond just that huge revenue number. How healthy is the core operation, especially when you factor in that the newly acquired brands, Alani Nu and Rockstar, they currently have lower margin profiles than the core Celsius brand?
Yeah, the profitability picture is actually extremely strong. It really shows the power of that core business. Gross margin for Q3 came in at 51.3%. That's up 530 basis points from Q3 last year, a big jump. And that improvement was mainly driven by scale benefits and being pretty disciplined with promotions on the core Celsius product.
Hmm.
Adjusted EBITDA was $205.6 million, which is just an incredible 4,573% increase year over year.
Wow, that kind of massive EBITDA growth really proves they have the financial strength to absorb these integration costs and the lower margin profiles for now. So what's the plan then for stabilizing those acquired brands? Like, what does stabilization actually mean for Rockstar?
For Rockstar, the immediate goal is, yeah, stabilization and starting to capture those synergies. That means probably rationalizing the portfolio, getting rid of some underperforming products, maybe optimizing the packaging. The medium-term plan, though, is what they call recapturing the magic, trying to attract those younger consumers away from the legacy giants like Monster and Red Bull, offering maybe more modern flavors, different brand messaging. They expect the margin profile for Rockstar to start improving quite a bit in the first half of 2026 as they integrate things like sourcing and production into their system.
And what about internationally? Where are they focusing their efforts to build that foundation for achieving true scale globally?
They seem focused on strategic, sustainable growth, not just planting flags everywhere. Australia is apparently performing strongly. They mentioned learning some valuable lessons from their experience in the UK market about how to penetrate effectively. And significantly, they've recently hired a new president of international expansion. That signals it's a high priority, building out that global footprint, but doing it systematically.
And underlying all of this activity is this focus on organizational excellence, right? Bringing in the leadership needed to manage what's become a huge, complex company very quickly.
Exactly. To really operate at what they call true scale, they've made some key hires recently, a new chief marketing officer, that president of international that we just mentioned, and also a new chief HR officer. These leadership moves really reinforce that management gets it, the organization itself has to grow and mature just as fast as the sales numbers are climbing.
Okay, so for you, the listener, let's try to boil this down. Here's the key takeaway. Celsius Holdings has really navigated this period of, well, strategic chaos and massive M&A using the power and control from that PepsiCo captaincy to grab an undeniable 20.8% share of the U.S. energy market. They are fundamentally the growth engine of this entire category right now.
Yeah, the sources really back that up. And they show that the modern energy consumer, what they want is twofold. Functional benefits, sure, but also constant flavor newness, which Celsius is really leaning into with things like those powerful LTOs, that which is brew example for Alani Nu, is perfect. And now they have the operational muscle through PepsiCo to execute that kind of strategy across three big distinct brands.
Right, and that intense focus now on internal efficiency, you know, optimizing the co-packing, the freight routes, the production, all to lift the margins of Alani Nu and Rockstar next year. In 2026, that sets up our final provocative thought for you. At the same time, they're doing all that internal work. They're also openly talking about potential price adjustments because of global headwinds. So as you look ahead towards those Q1 2026 results, here's the central question to ponder. Is Celsius ultimately built to win primarily on scale and operational efficiency gains? Or are they going to rely more on that, perhaps easier lever of price increases to hit their margin expansion targets next year? Keep a close eye on how they talk about pricing versus those synergy gains in the coming earnings calls. It'll be telling.